currency equals debt. And when you hold a currency, you're holding a debt instrument. And so all of those will decline in value relative to other things. All currencies have a lot of debt. And so when you look at one relative to the other, there will be a lot of printing. I mean, here's the problem. If you're borrowing more money than you're lending, and you have a lot of debt, you either are going to pay back in hard money or in soft money. And so it creates a very difficult trade-off.
Given where inflation is what the Federal Reserve likely to do on rates this year? Push countries from success into failure?
Well, there's two ways of dealing with debt. You pay it back in hard money or you pay it back in soft money. You pay it back in hard money, you have a depression. So throughout history, whenever that was done, pay it back in hard money. Eventually, that was abandoned and you print money. That was what 71 was. That was what March 1933 was. What you have to think about is the value of money. How much money does one have in debt instruments? And do you want to own that as an asset? I think they're bad assets. Think about how much money is being stored in debt instruments, those debt assets. Think about how poor those returns are. So that is now a problem, particularly for the dollar, but it's also a problem for other countries. So that's why you have inflation. As money goes into other things and the cost of borrowing is so low relative to the inflation rate, then it encourages the borrowing of money and the sale of money. In other words, not holding financial assets like that. The trade-off becomes more and more difficult, and that's what brings about a stagflation environment, because they tried to navigate between those two undesirables. In other words, they want to contain inflation, but too high of an interest rate that's good enough for inflation causes too much economic environment. So what can they do? No, they're in a position already because of that dynamic, spending more than they're earning, creation of a lot more debt, and a lot of other debt, which one man's debts are another man's assets, and that as the holder of that assets is losing money. Imagine holding a bond now. Only in cash, you don't get any return to compensate for the interest rate, and in your bond fund, you get negative returns. And how's that feel? So are you going to continue to hold those bonds in that bond fund? It's a dynamic that they have to deal with that is really beyond their capacity to deal with it. They can't change those fundamentals. I think that most likely what we're going to have is a period of stagflation. Shift from one mindset, and positioning of that mindset to another mindset and another positioning of that. Once that shift begins, it causes a reinforcing dynamic. It's like everybody is long bonds. We've been in a 40-year bull market in bonds. And so it's been fine to have. And when that shift starts to take place, you see behavioral shifts that reinforce that cycle in the paradigm. So for example, when there is the selling of bonds, that it makes it more inflationary in and of itself, because the amount of debt that has to be sold is not just the deficit, but also the amount of debt that's being sold is those bonds. So now interest rates have to rise a lot, or the Federal Reserve has got to come in there and buy more. So a paradigm shift is beginning to take place, and that will be also self-reinforcing. And it's taking place in this context of the conflict, which then creates the breakdown of efficient systems. Each country wants to be self-sufficient. It needs to protect itself. And in being self-sufficient in that way, then you have less efficiencies in the system. And all of that becomes self-reinforcing. So it's all happened before. It's all happened many, many times before. That's covered both in the video and the book. So it's, I'm concerned about that.